I've started to study this book, The Psychology of Money by Morgan Housel. Absolutely incredible book. I would highly recommend it. But be prepared for your ideologies surrounding money, how luck plays a role, how risk plays a role. Be prepared for your ideologies to be absolutely challenged. It certainly challenged my views. I've been reading this book, and after every single chapter, I find myself having to take a minute to just kind of go over in my head what I have studied, what I have learnt. But that's an indication of how incredible this book is when it challenges your ideas, because it's almost, I almost feel like my mind is being expanded the more I read this book. So I actually want to share with you this chapter 5. Okay, so this is a chapter from the book. I want to share this with you before we go into some of the stocks that I picked up this week. Okay, so this is chapter 5. It's talking about getting wealthy versus staying wealthy. And, he gave an example of Jesse Livermore. I'm not sure if you guys know about Jesse Livermore, but he was a famous trader who, he made a killing in the 1929 crash. He shorted the market. And whilst all other traders at the time, they pretty much went bankrupt because they took on so much debt and they got crushed by the crash and the depression. A lot of them took their lives. He became rich. He became stinking rich, making over $100 million, inflation adjusted, and he became very well known. But the problem with Jesse Livermore is that he didn't stay wealthy. And that amount of wealth that he amassed gave him an incredible amount of confidence, whereby he then began to over leverage himself. And then he got crushed a couple of years later in the 1933 crash. And in the end, he ended up taking his life, which was crazy. So that's a crazy story. That's just one of the stories in this book. So you need to get this book. I'll leave an Amazon affiliate link in the description below. You can check it out. This really resonated with me, okay? Because when we invest, especially a lot of the newbie investors who started investing last year, during last year's crash, you've only experienced the market go up rapidly. And that now becomes your expectations for the market. But last year was an anomaly, all right? It was the fastest crash on record, and it was the fastest recovery on record. All of the analysts were saying the V-shaped recovery was impossible. I mean, you only really had the likes of Cathie Woods, who was bullish and saying, look, there will be a V-shaped recovery. All of the experts, all of the analysts at the time said it was impossible. But look, Cathie Woods was right. We did have a V-shaped recovery. But I think that has spoilt the idea of traditional investing, and we now expect that to continue being the norm. But unfortunately, it isn't the norm. And the reason why I want to share this chapter in today's video is just to really hammer home the point that, look, this is a long-term game, okay? Contrary to what you experienced in 2020, this is the reality of investing, okay? And it says, look, compounding only works if you can give an asset years and years to grow. It's like planting oak trees. A year of growth will never show much progress. 10 years can make a meaningful difference, and 50 years can create something absolutely extraordinary. And that made me just look at my portfolio again, because sometimes we look at our portfolio, we say long term, but most of us, our long term is, well, judging from some subscribers' comments, your long term is 6 months. Most of us have a 1 to 3 year horizon. Again, that's not even long term. All right. He's talking about, 10 years can make a meaningful difference, and I'm looking at my portfolio, I'm looking at my largest positions, and, you've really got to ask yourself, like, do I see Ttcf? Do I see Palantir? Do I see Celsius Holdings, being around in the next 10 years? And not just being around in the next 10 years, but also growing and thriving and becoming a beast within their field. That's how I'm now assessing my portfolio after reading this chapter, because I'm like, look, sometimes we can get so short-sighted, but we have to realize that we have to give our assets time to grow. Ttcf, I only invested in that stock in October, so it's not even been a year yet, and there's been so much drama amongst retail investors. It's absolutely crazy. But reading this, I am now looking at my portfolio with a different perspective, a different lens. I have a 10-year lens now, I have a 50-year lens, and if I can honestly say that I can't see this continuing to be a beast within the next 10 years, then should this really be in my portfolio? And I think this is a question that we all need to ask ourselves and be honest with ourselves, okay? But it goes on to say, but getting and keeping that extraordinary growth requires surviving all the unpredictable ups and downs that everyone inevitably experiences over time. We can spend years trying to figure out how Buffett achieved his investment returns, how he found the best companies, the cheapest stocks, the best managers. That's hard. Less hard, but equally important, is pointing out what he didn't do. Now, this is where it gets juicy. He didn't get carried away with debt. He didn't panic and sell during the 14 recessions that he has lived through. I'm going to repeat that again, all right? He didn't panic and sell during the 14 recessions he's lived through. Crazy. He didn't sully his business reputation. He didn't attach himself to one strategy, one worldview, or one passing trend. He didn't rely on others, brackets, managing investments for a public company meant investors couldn't withdraw their capital. He didn't burn himself out and quit or retire. I mean, the guy is 90 plus now and he's still going. He survived. Survival gave him longevity, and longevity, investing consistently from age 10 to at least age 89, but we know he's 90 now, is what made compounding work wonders. That single point is what matters most when describing his success. But you hardly hear about it. You know, you always talk about, his investment in Coca-Cola, his investment in Apple, this, that, and the other. But in reality, this guy has been investing since age 10, and he's been through a lot. He's been through wars, he's been through rumors of wars, he's been through pandemics, all of these things that could make you panic and sell your position. We don't focus a lot of attention onto that, but that really is the secret for Warren Buffett's success and why he is where he is right now. So I wanted to share this with you, and I hope it gets you thinking like it did myself. And now let's crack on to the videos. So taking a look at Friday, and it was a bloody day. I mean, every single sector got battered. Okay, we got tech, consumer electronics, financials, whatever sector it was, consumer cyclicals, communications, healthcare. Every single sector got destroyed. Even more so the utilities, basic materials, the industrials. They got destroyed, okay, on Friday. And that's all down to the Fed, okay? So our main man, Jerome Powell, all these officials brought forward their forecast for tighter monetary policy after boosting inflation projections, okay? So Jerome Powell did the unthinkable. He came out and just stated the obvious, okay? It was glaringly obvious, inflation is here. Inflation is getting a little bit out of control, and he's had to come in and, interest rates going up is pretty much the only way the Fed can fight this growing inflation. So the Federal Reserve's officials expect to start raising interest rates in 2023. I'll be honest, I think they're even going to do that earlier, okay? Now, this was earlier than previously forecasted, according to new economic projections that predicted faster growth and sharply higher inflation this year. I speculate that they're going to have to start raising interest rates next year. 2023, I think, is still a little bit optimistic, and I think it's still trying to kind of calm the storm. Regardless, that caused a lot of fear and panic within the market, and it was a red day overall. And you guys know me on this channel, I love red days. So of course, that's when I started shopping. First set of shares I picked up was in Celsius this week. I'm still building this position. I'm now just over 300 shares in this company, and my average price is $50. This company is expensive, but I really liked how we performed in Q1. I compiled a full report of our Q1 performance and I made it into a document. I gave my commentary and some of the highlights that stood out to me and what I felt it meant for the business going forward. And I shared this entire PDF document with my Discord. So if you want to get access to this, you need to join my Discord group, and the Patreon link is in the description below. But as a result of my summary, some of the accomplishments that we made in just Q1, I'm looking at Celsius. Remember what we read from The Psychology of Money? I'm looking at Celsius with a 10-year lens at minimum. And I just see an incredible amount of growth ahead of us. And I think, this market cap at 4.8 billion, yes, it seems expensive right now, but in the next 10 years, this 4 billion market cap will be an absolute joke, in my opinion. And they've started to roll out Celsius branded coolers in the likes of Targets and Kroger. Shout out to a Discord member, Tattooed Planet Tesla Palantir. He shared this cooler in Kroger. As you can see here, I love the branding. It stands out, it pops. Best served chilled. Absolutely love it, rather than just being on the shelves where it's a bit warm. It's very bright. This will attract customers, and you can see it's starting to sell already. And our Discord members said that Target is always sold out. which is key. Target is always sold out, but Kroger never lets them down. And I can just see more of these coolers in so many more retail outlets. And they haven't even begun full expansion into Europe yet. They're still just only taking over North America. In the UK, this is all we've got, right, so far. On Amazon right now, you can order the Celsius. These are the sachets. So essentially, you order the sachets and you dilute it. And this is pretty much all we have available for Celsius products in the UK as it stands. So with Celsius Holdings, with a 10-year lens, I see this company being an absolute beast. You know, it's already competing with the likes of Monster and Red Bull on Amazon US, you know, outselling Red Bull for the first time in history. And Celsius is now in second place, Amazon US within the energy drinks category. And I just see so much growth ahead of it. Again, I won't argue with you. The valuations are very high with a PE ratio of 571. I do think in an environment where inflation is, you know, getting out of control and interest rates are going up, I do see Celsius maybe consolidating around here. And this is giving us time to build our position. Even if it consolidates or even if it drops lower, I will continue buying because my goal, I want to own 1,000 shares of Celsius. So I would be very happy if the price consolidates around here, giving me time to build, you know, a solid position and then just hold on to this baby for the next 10 years. That would be incredible. So I loaded up on Celsius this week. So next up, Ttcf. I'm not going to spend too much time on Ttcf. I've released multiple videos on Ttcf this week. And in my previous Ttcf video, I actually showed you guys my purchase order. I picked up 100 shares of Ttcf. Again, just think about Ttcf 5-10 years from now. Just try and picture it. And, you know, it's incredible the amount of growth. And you look at our market cap right now. Our market cap is what? $1.6 billion. And Stephanie told us that we have a clear pathway to $1 billion by 2026. We're in 2021 right now. So that's literally in 5 years' time. I mean, this market cap will get absolutely blown out of the water if we can continue to execute. And, you know, she said with our current manufacturing capacity, we're sitting on $500 million. That's pretty much nearly half our market cap at 1.6 billion. Okay, maybe a little bit under half, but you get what I mean. But again, with a 10-year mindset, can I see Ttcf at this market cap, you know, by 2026, let alone 2031? No. You know, I think this would be I think this company will be an absolute beast, and that represents a ton of upside for us early investors. So Ttcf, I picked up 100 more shares of Ttcf, and you guys know the reason why. Now, last up, we have Hims. Hims got battered this week. Again, those fears surrounding Amazon Care is still lingering. We had our online virtual shareholders meeting this week, but Andrew wasn't present. I think he was on paternity leave, and in the end, it just ended up with the board members being voted back in, and there was no questions during the virtual event, and they didn't provide us with any major updates to what we already knew with regards to, you know, bringing on Miley Cyrus for the her side of the business. So nothing really changed. Again, news surrounding the hiking of interest rates and bringing it forward to 2023 scared off more investors. Hims market cap right now is sitting at 2 billion. The share price was down 9.76% over the last 5 days. Now, I'm very close to finishing my position in Hims. I'm sitting on over 700 shares. My goal is to get this to 1,000 shares, and then I'm going to sit tight and watch this asset grow over the next couple of years to come. So those are the stocks that I purchased this week during what was a bloody week. Let me know in the comment section below if you went shopping, and if you did, let me know what you picked up. Thank you so much for watching, guys, and I'll catch you in the next one. Peace.